Hello and welcome to our latest Fund Manager video interview. Today I'm joined by Sue Noffke, Manager of the Schroder Income Growth Fund, which is an investment trust. Sue, thank you for your time today.
Pleasure.
Firstly, Sue, could you run through your investment style and approach, the sorts of qualities and attributes that you like to see a business possess?
Of course. So the way I invest is very much bottom up rather than top down. Now, what does that mean? It means that whilst I think about the economic outlook, I'm really looking for individual stock stories and compelling investment ideas. And to do that, I undertake a lot of fundamental research. So it's really trying to identify those investment opportunities that are going to deliver for the objectives for the trust. And that can be the dividend objectives, but also the capital growth objectives. And so I'm really looking for mispricings, things that are misunderstood, in my view, by the market. And they can come across the whole spectrum of size and quality, growth, and valuation biases. So I hold lots of different companies that would fit into those categories. As a whole, the portfolio is kind of on the cusp of value and core and mid and large cap. So we do have some small companies, but we have a blend of large, mid and small companies within the portfolio. And in terms of the attributes that I'm really looking to exploit, it's around the franchise. It's about stocks that are advantaged in the current environment. It's self-help and recovery plays, as well as those sustainable growth franchises that I really like. And I'm looking to avoid things that really have high valuations, too much debt, or are likely to be disrupted in any way.
And looking back on 2020, it has been a very challenging year, to say the least, to be an income investor. Were you surprised by the wide-scale dividend cuts that took place in response to COVID-19?
Yes and no. It was difficult not to be surprised because it is the most significant size of cuts that we've seen, probably about double that of the global financial crisis, which is most investors' recent reference point. But I think the time at which it came, the fact that it's a global pandemic, we haven't seen one of those for 100 years, really puts it in context. But the sizable cuts that we've seen across the market have really come from those areas that probably needed to cut or rebase the dividends in any case. And this was the catalyst for them to do so. So if I think about the oils companies, BT, for example, these are companies that need to invest for the future. And they found the money to invest by cutting the dividend, rebasing the dividend. And then other areas that contributed to the significant fall in income for the market as a whole came from banks where the regulator said no to payments. And so elsewhere across the market, I'm kind of less surprised because a lot of companies were just in the process of paying their final 2019 dividends. So if we think back to March and April, just when COVID took hold across Europe, and a lot of boards just didn't have any idea what the situation was. So they paused. And what we've seen is a thawing of that decision. And many companies are starting to come back. So I think as we end 2020, the prospects probably are not as dire as they at first seemed in the early part of 2020.
In that early part of 2020, in regard to portfolio activity, how did you respond to the dividend black hole that emerged?
Well, as you've explained, the product I run is an investment trust. So we were very fortunate to have built up substantial revenue reserves for just such a time when income was more challenged. So we were able to not panic and take our time to reassess. But the other feature of investment trusts is quite often they can deploy gearing. So one of the first things we did was take down that level of indebtedness across the portfolio. We didn't take it out entirely, but we moderated our levels of gearing from about 15 to about 10. And we sold some areas of the market that had, in our view, had their investment thesis disrupted by COVID. So I've talked about big oils and also about banks within financials. And within oils, we'd already been reducing our exposure from about the autumn of last year, and we accelerated our reductions further in January, February, and through really the first half. And looking at banks, our investment thesis had been predicated on a more benign UK domestic economy, where the path for interest rates would be up and not down. And so COVID really turned that investment thesis on its head. And we took the view that we should move on and redeploy that capital elsewhere, particularly in life assurance companies and other financial services. And so we exited all the banks in the course of the first 5 months of 2020 and redeployed that into either existing holdings or building up new positions in, for example, Direct Line and M&G Group.
And the trust backs around 34 holdings. How many of those are currently paying a dividend?
Just about all of them, but it's a question that's open to interpretation in how I answer that. So I did a bit of an analysis of the portfolio, and something like half the names have seen some sort of disruption to their dividend over the course of this year. So some of them might have paused and then restarted. Some of them have rebased down. So we still have a small holding in Royal Dutch Shell, for example. And some of them have had other things go on. So TP ICAP, for example, has cut its dividend in order to fund an acquisition. And Prudential Group has seen M&G been demerged from its operations, and so it's rebased its dividend down. So probably about half the names, but about a third of the portfolio has seen some sort of COVID impact on their dividend over the course of the year.
And since launch, the Trust has raised its dividend every year for the last 25 years. And you touched on this slightly earlier, but I wanted to ask whether the dividend reserves were utilised in 2020 to maintain that track record.
Yes, they were. So we've just published our report and accounts, so I can be quite open about what the impact has been. So income fell about 17% over the year, and we had a not quite covered dividend of 12.6p, and we used 1 month of dividend from reserves to top that up. Now, when we went into 2020, we had a full year's dividend in reserve. We end 2020 for the fund year in August 2020, and we have 11 months of dividend currently in reserve. So still a very strong position to be able to assure investors of continued dividend growth.
Sue, thank you very much for your time today.
Thank you, Carl.